Ladies and gentlemen, good morning. As always, we start with the short end of the US curve. This is a daily chart of the 5-year note yield, and as expected last week, it has come in to trade and fill the gaps that it has left underneath. It is quite significant that it has not managed to fill in the gaps completely and is now, we think, stuck. The Bollinger Bands are coming in very fast on both the daily and the weekly. We have the moving averages rising to meet the price, and we still expect several more days, if not weeks, of consolidation at these levels, maybe forming an ABC pattern before it's ready to decide on the next move. This actually marries in beautifully with the US politics. We've had the failure of the healthcare bill. Now we have to decide, or rather the market has to decide, whether tax cuts are going to take place and what shape they will take place in. And according to their magnitude, the market will then decide on making the next move, which we still expect to be substantially higher from these levels in the 2-year note. In the 5-year note. At some stage this year, we would not be surprised to see the 5-year note trading well above this 210 level, probably around the 240, 250 area, which we suspect will be the high for this year. But for the next few days or weeks, we are probably stuck within a range of, say, 205 down to 187, about a 20 basis point range up or down, which will probably take us at least 2 or 3 weeks before the market sees the possibility of further moves. The same is evident in a chart of the 10-year note. We have cascaded back to within the lower part of the range. It is going to be very, very tough, I think, at the moment to bust through the 233 yield level. Don't expect it to happen for a while. So basically stuck within 230 to 248, 250 for the foreseeable future before we can make a move based on the politics in the US. We certainly think that any move down towards the 213 area, which is the 0.382 retracement and the filling of this gap, is going to be a very, very good buying opportunity in terms of yields, i.e. selling opportunity in terms of futures for a move which should take us back up towards the 260 to 280 area sometimes this year. We still think that the 10-year yield chart is far less bearish than the 5-year, and therefore being in terms of futures contracts short of 5 years and long of 10 years is still a position which should be attractive over the next few weeks and months. IEF, which is an ETF of the 7 to 10 year area, shows much the same characteristics. It has failed to go down beyond the 103.50 area, which was the previous low. It is now backing and filling. It might try to take out the stops above 106.30, but we think that that move is going to be short-lived. All the moving averages are now catching up, and we think that the next bigger move or better move will be to sell the 106.50 to 107 area for a move back down towards the 103 area within the next few weeks. The situation in Europe is likewise, as we suspected, one of a flattening yield curve. We have the 2-year note Having given up all those panic gains of a few weeks back, stuck now trying to very slowly turn the moving averages and the Bollinger Bands and all the other technical indicators towards the upside or the less negative yield. But this, as we said, is a process which is going to take many weeks. We don't expect any significant movement in the short end of the German curve, certainly not until the end of the French elections, where we suspect we will have a significant flattening of the yield curve, simply because people will start anticipating less expansive ECB monetary policy, and also the start of the European cycle of rate hikes. But that is still very much months away as opposed to days away. So this is going to be a very slow process of trading from -60 to say -80 or 85. It is going to take many weeks of price action in this area before we're ready to go towards the 0% yield level. The Bund, the 10-year, is similarly stuck. It took a long time to start making the move higher in yield. As we suspected, it is now in a position to digest that move. Don't forget the yield curve is flattening. You can see that there is very little upside in Bund yields at the moment. The preferred position is still to be long of the Bund and short of the 2-year Schatz. In fact, we have the position where we are long of OATs, simply because we think the French yields are likely to come in even more than the 10-year German yield. So we still think that we will at some stage over the next 2 or 3 weeks trade around the 0.32% yield area, and basically follow the 10-year note in the States up and down within quite a narrow band in the bunds before we are ready to make the next move, which we expect to be higher, but only 20-30 basis points higher, while the 2-year note in Germany can move probably 50, 60, 70 basis points higher in yield. So again, flattening, being short of the 2-year and long of the 10-year in Germany, or in France, even better, and just collecting the yield differential. Well, having expressed those views in the interest rates, it is not surprising that on a daily chart of the euro we see that very little happened after the initial thrust higher, which we caught to the tick. The 108.27 area is going to be very difficult to break and sustain. We don't doubt that the market could move up to the 108.40-50 area just to take out these stops and fill this gap, but we doubt that it can sustain moves higher than 109. We are now overbought on the stochastics. We are very close to daily Bollingers and the 200-day moving average. We are more likely to come back and fill towards the 106.50, 60, 70 area, where we should gain enough strength to finally mount a serious attack on the 200-day moving average. On the weeklies, much the same thing is evident. These Bollinger Bands are coming in very fast. We still have the downward sloping moving averages. It's going to be very difficult to sustain these levels without coming back down towards the 106 area and gathering enough strength over the course of weeks to try and bust higher. Certainly with our view of yields both in Germany and in the US, it is difficult to see what is going to provide ammunition now for any moves which are much more than 1% to the upside, and let's call it 2% to the downside. The dollar index is similarly very well supported. We have the 0.382% retracement coming in at 99.27 of the whole move higher. We have the 200-day moving average, and we have this trend line which has caught all the lows all the way from April last year. Therefore, we think that this area around between 99.27 and 98.60 is going to be very difficult for the DX to break through over the course of the next few days and weeks, simply because it does not have any ammunition from interest rate differentials. We think that the whole move of the interest rate differential has more or less been exhausted. We still think eventually the move will happen when we break this trend line, and we still fully expect the DX to trade probably quite a bit lower over the course of the next few months, but we just can't see it happening at the moment. We think this is going to be a market which takes out all the stops on the downside, then takes out all the stops on the upside, and then basically does a pattern like that before it cascades to the downside. Gold has done very much what we expected. It failed to hold and or break the 1250 area, which is pretty pivotal. The weekly Bollinger Bands are coming in to catch it. The moving averages are still downward sloping. We think now that with the move back in the dollar index and in of course in Euro USD, we could trade back down towards the 1200 level, between 1200 and 1250, gathering strength to break one of these days this trend line on the back of a move in DX. It is a process. We don't see it happening very quickly. It might be something like this, where it took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks of action. That is nearly a whole quarter before the move started and developed. The US stock market has actually met our minimum objectives for the retracement, which were between 2320 and 2340. We still don't think that this is a trending market. We have definitely not changed our bull perspective in terms of trend. This is backing and filling. We could extend lower over the course of the next few days, but we certainly do not expect to see at any stage the market trade below 2280. We think that we could have moves back up to the 2360, 70 area, followed by moves back down towards the 2320, maybe 2315, but that is the kind of trading range we expect. This is a fourth wave before either a fifth of the third, or we have the whole of the fifth targeting around 2500. We certainly don't expect this to last more than say a couple of months, but we do expect it to last at least another month, worth of consolidation between say 2220 and 2360-70 before we have the next move higher. We're waiting for all these indicators to turn to oversold before we just churn around these levels. we don't think we will be heading much lower and certainly not much higher for quite a while. Some commentators that we follow have made much about the recent small uptick in volatility. We think they don't know what they're talking about, simply because you can't trade or position spot volatility, and therefore what you have to look at are ETFs like VXX. VXX naturally is in a permanent downtrend with small spikes, simply because the yield curve is so steep in volatility that the passage of time without huge volatility, which is a norm, erodes the value of the VXX. If we have a look at what's happening and what has happened to the VXX since the beginning of the year, basically started the year around the 24.5 level, and it's now trading below 17. So anybody who's been long of VXX has lost over 30% since the beginning of the year, even though we've had this small uptick. Our opinion is that nothing is happening in volatility apart from a range until we break the 1850 to 1860 level in VXX. If we were to break that, that would suggest that we are wrong in terms of very small extensions to the downside in US equities, and that we could have an acceleration of the downside. We certainly don't expect it, and we think the 1840, 1850, 1860 area is going to be a very good sell in VXX. The one market that we like, which is the stocks, is certainly losing impetus, but we wouldn't expect it to be going up much more as the S&Ps give up ground. What we would expect it to do is exactly what it's doing. It closed the week exactly where it started the week, while the SPX gave up well over 1.5%. So it is doing exactly what is expected of a strongish market, i.e. not going down while the other markets do, or going down far less than the other markets. We still think this is a positive pattern. We see absolutely no fear in Europe. We think that any and all dips of a range of 2 to 3% will be bought for eventual tests of at least this high around the 3800 eventually. 3500 is our first objective, 3800 much later in the year. So much more positive of Europe than we are of the States. And here we have our spread of SPY against FEU, which is the stocks that we just showed you. It has a large component which is Euro USD, but here we have definitely made the first lower high, lower low of this whole move up. We are now at a level which is good support. This is the 52-week moving average. We would expect that spread now to compress around the 741 level before breaking down and retesting this trend line, which is much lower. That would suggest that FEU and SPX and the dollar will do very little for the course of a few weeks and then break down and retest this trend line over the course of the summer. So that all ties in with our view of Euro USD. It ties in with our view that SPX is going to do very little over the course of the next few weeks, and that the stocks is going to be stable to upwardly nudging, as opposed to the SPX, which is going to be stable with small downward extensions. We still like this position. We think that with minor retracements to the upside, it is going to be a big move into the rest of 2017, back down to at least this moving average, which would give us probably a 6 to 10% move in the spread. We have many other risk on, risk off indicators, and this is one we thought we'd share with you today, which is SPY over IEF, IEF being the 7 to 10 year bond area, and SPY being naturally the S&P 500. You can see how it has been in a very nice uptrend since 2009. It is trading very nicely within these parallel lines. It got very close to the top of the parallel lines a few weeks back, and now with the move back in SPY and the move into IEF off the bottom, it has very nicely retraced. We think now this churns in this area for quite a few weeks and then makes a new high sometimes in the late summer or early autumn, which should be to us a sign again to exit the stock market. We expect it now to do something like this for a bit, trading sideways, letting time catch up with it, and then finally making the move higher. This is another indicator that we like in terms of risk on and risk off, and that is HYG over TLT. HYG being junk bonds, and TLT being the long end of treasuries. As you can see, it gave up quite a bit over the course of the past couple of weeks, and that coincided with a risk-off move in US equities. We are now at decent support. We have not broken through the 0.71 area. We think now this indicator probably will trend sideways, or rather trade sideways, until it catches this trend line, which has held it basically since the early part of last year, and then we shall make further highs, taking it back up to these levels. So we think that everything that we look at, all the inter-market relationships, are basically telling us the same. This is not a trending market, this is a trading market. Extensions to the downside in equities are likely to be small, but it's still an overall risk-off market rather than a risk-on market. It is not, it is basically a seller rip market rather than buy a dip market for the next few months. You sell a rip and then you rebuy the dip, sell the rip, rebuy the dip. That kind of market, certainly for the foreseeable future. With all that said, our biases for next week still continue to be short FV, the 5-year note, long TY. If you are naturally long always of stocks, look to put on a small position short HYG, long TLT. That could nicely hedge your equity position and certainly not do too much harm if we are wrong in our view and there is a violent risk on move. Bund and Bobble, as we've shown you, completely politically driven at the moment. Still the safest position to have is to be short of 2-year notes and long of 10-year notes, and just keep on getting the carry. The commodities are not doing anything, nothing yet, but the weeklies are beginning to get to oversold levels, so we still could be a few weeks away from any signal from commodities about bonds. And it's all tying in, isn't it? Commodities, i.e. oil, gold, industrial metals, everything is telling us that we are in a consolidation as opposed to a trend. And that is what the equities are telling us as well. The third wave is exhausted. We have met now the minimum retracement objectives. The way I would play from now on is still put spreads. Every time there's a rip of 15 to 20 points, you buy the put spread. Basically, you buy the at the money put and you sell the out of the money put in about 30 to 40 points differential. So if it goes up to 2360, you buy the 2360 puts and you sell the 2320 puts, and you can even do it on a ratio basis 1 by 2, and then basically when the market comes down over the course of the next few days, hopefully you take it off at a sizable profit. NQ, we are neutral. We think the XLK XLI relationship is very high. We would not be better buyers of NQ over ES at the moment. We'd much rather let that settle. Russell 2000, well, we picked those levels, closed below 1339 and below 1346. The market tried both and achieved neither, which shows you this is not a trending market. We have no doubt that we will see moves to those levels, but we just don't think that that is sustainable. In fact, we can probably show you a chart of the here it is. This is basically the relationship between SPY and IWM, which is the Russell. You can see we are at a very, very significant trend line. And that trend line would probably coincide with a break of the level that we have written around below 1340. The move since November has been actually, in fact, December. This is November when we got the huge risk on move, and now we have retraced a large part of the of that move. We are coming to very important levels where we can draw this trend line down from the beginning of 2016, when the risk off move really petered out. So we would be surprised to see violent breaks of this trend line over the course of the next few weeks or days. We think it's more likely that we just basically trade into the apex and then slowly come back off in this spread. So that is why we don't think it's likely that the Russell will break the 1339 on a weekly closing basis anytime soon. If it does, we think we're probably in a sell-off phase for all US equities. As we said, European equities, we still think that they are much more bullish than the US equities. If FEU ever came back on the back of an SPY dump to the 3020 level, we think that is going to be a gift for the rest of the year. DX, as we said, the pattern is still there. Unless we regain 102 over the course of the next several weeks, a break of that 98.50 level that we showed you was so important is more likely to happen than not, and it will have big consequences. The big trade is still, we think, in Europe, short of 2 and 5 year notes and long of the stocks. It's a risk-on move. It has to be balanced and has to be put on in stages because you don't want to be caught by a violent risk-off move. So you always want to have ammunition to put it on. But we still think that over the course of this year, this should be very well. The Dow transports were the tell for this fourth wave retracement. We are following closely what it does. So far it's done, the transports have not done much wrong. They're still retracing, but if they start trending, it will mean that the ES can make much more profound retracement levels than the 2320 or maybe 2315 level, and we will warn you in time. Our spread risk on risk off indicators that we will show you more about in the next few weeks are inconclusive. They're basically saying the market doesn't know what it wants to do. It is not in trend. Basically trade it, do not position. So those are our biases for next week. Thank you for following us. Hopefully we've told you something you don't know or you can look at, and we will tweet away any changes and opinions over the course of the week. Thank you very much.